This week, I want to start by taking a step back and putting the current market into perspective. I recently came across a great chart from Goldman Sachs. It shows the S&P 500 has gained roughly 100% over the past 4 years, and that's before accounting for dividends. That's a remarkable run. Historically speaking, it's pretty rare. So going all the way back to 1928, a 4-year return of this magnitude ranks well into the top 10% of all rolling 4-year periods. What's even more impressive is everything investors have navigated along the way. So over these last 4 years, we've lived through periods of elevated inflation, followed by aggressive Fed rate hikes, the Liberation Day and trade war scare, and finally, more recently, a supply shock caused by the conflict in the Middle East. And despite all this uncertainty, the market has continued to climb. So when people see a chart like this, the natural question is, have we come too far, too fast? I don't think that's the right conclusion. I do think it's important to appreciate just how strong this run has been and to manage our expectations accordingly. The good times don't necessarily have to be over, but after a move like this, things need to continue going right. The encouraging part is that this hasn't simply been a rally driven by AI euphoria. It's definitely been an important tailwind, but I think the biggest driver has been corporate earnings. Companies have continued to grow profits. In the economy, it's remained surprisingly resilient amid all this uncertainty, and that's provided the fundamental support for higher stock prices. So looking ahead, analysts continue to see healthy earnings growth over the next couple of years, and that's certainly encouraging. It also means expectations are high, and companies will need to continue delivering, and investors will want confirmation that the AI investment story remains intact, and that businesses are still aggressively investing because they see attractive long-run returns. They see this paying off, and that earnings growth is becoming broader across the economy, not just concentrated in a handful of AI-related companies. That brings us to this week, which could give us some important clues about whether those fundamentals remain in place. So on Tuesday, which is tomorrow, we'll get the latest consumer price index, or CPI, which is one of the key measures of inflation that we watch. And this month's reading, which is based on June data, should come in a bit lower than the previous month, but we're no way out of the woods, especially given the recent re-escalation in the Middle East over these last few days. Then on Thursday, we'll get retail sales, which provides one of the best snapshots of the health of the U.S. consumer. And consumer spending drives about 2/3 of the U.S. economy, so this report gives investors a better sense of whether households are continuing to spend despite inflationary pressure and ongoing geopolitical uncertainty. This week also marks the start of second quarter earnings season, and I think that's likely to become the market's biggest focus over the next several weeks. Current expectations are for the S&P 500 earnings to grow roughly 24% compared to a year ago. Energy is expected to be the strongest contributor, helped by higher oil prices following the conflict in the Middle East. But information technology, not too far behind. It's once again expected to post strong growth as companies continue to benefit from AI-related demand. But one statistic that stands out to me is that analysts expect earnings growth from 10 out of the 11 sectors in the S&P 500 this quarter. I think that's important because investors have been waiting to see earnings broaden beyond just a handful of mega cap technology companies, and we're starting to see it. If this does happen, it would be another healthy sign for the overall market. As earnings reports begin rolling in, we'll be paying just as much attention to what management teams say as to the numbers themselves. We'll want to hear that companies remain confident enough to continue investing in AI, that they're still seeing demand hold up, and that profit growth remains healthy across a broader range of industries. At the end of the day, I don't think a strong 4-year return is by itself a reason to become nervous. Markets have delivered exceptional returns over these last 4 years because earnings in the economy have largely supported them. But what it does enforce is why we continue to focus on diversification. None of us knows exactly what the next market leader will be or what challenge investors will face next. A diversified portfolio allows us to participate when opportunities broaden while also helping manage risk if expectations become a little too optimistic or if leadership begins to shift. This week's inflation report, retail sales data, and the start of earnings season should give us a better sense of whether the key drivers behind this bull market remain in place. But I'll leave it there for now. As always, if you have any questions, please feel free to reach out to your advisor, and I'll see you soon.